So, the star of the crypto industry and the second largest cryptocurrency exchange FTX have gone bankrupt, with Sam Bankman Fried, the founder, who lost $16 billion overnight in an epic collapse, which I'm sure you've already heard in the news. And of course, a bankruptcy as fast and sudden as this will have many intricacies. I mean, the company structure looks like this, with around 134 separate companies referenced in the bankruptcy filing. So yeah, this will have far-reaching consequences. From big VCs like Sequoia, Tiger Capital Management, the Ontario's Teacher Pension Plan for God's sake, and of course SoftBank losing a ton of money, finance YouTube influencers rushing with their apology videos as they all promoted FTX on their channels, and unfortunately, the viewers on these channels who put their money, possibly their life savings, because they've trusted these so-called influencers. But what about the cryptocurrency ecosystem as a whole? I mean, this is not the first time a crypto-affiliated company is undergoing such crisis. There's also the crisis on Celsius, Voyager, Three Arrows Capital, Terra and Luna Unstable Stablecoin, and many more. Not to mention, cryptocurrency as an asset has done pretty badly in 2022. So, what's next for crypto? And what does the FTX bankruptcy mean for crypto going forward? Now, to understand all of these, we need to break down exactly how and why FTX went from being valued at $32 billion by VC investors just a few weeks ago until it eventually collapsed. So, FTX has a token called FTT. Basically, if you're an user of FTX, you can use that FTT token to get discounts on trading fees, increase commissions on referrals, or earn rewards when you're trading on FTX. The more FTT you hold, the bigger the discount that you will receive. These are all incentives to ensure that FTX users will want to hold on to and use the FTT token. For FTX, the benefit of issuing an FTT token is that by minting these tokens and then keeping a bunch of them, they can generate lots of money and even use the token as collateral to borrow more money, which is a viable business model until it isn't. Note that FTT wasn't created by selling off equity, but by printing it out of thin air and then assigning some benefits for using them, besides promoting big on social media to build its hype. Now, the value of the FTT token is upheld by repurchases and token burnings, as FTX has promised to use a third of its profits to buy back FTT tokens every single week. Meaning that the more profitable FTX is, it can buy back more FTT tokens to decrease the number of tokens available, therefore increasing the price. So unlike many cryptocurrencies like Bitcoin, which is inflationary by nature, FTT token is deflationary by nature. Of course, the FTT token price increase by decreasing its supply can only happen if demand for the token remains consistent, which is a big if. This mechanism is the very same mechanism as stock buyback programs that you often see in public companies, which can be very profitable to its shareholders if done right. But to clarify, FTT tokens are not shares. The real shares of FTX are held by VCs like Sequoia Capital and SoftBank, but FTT tokens behave like shares in the sense that it is a vote of confidence on FTX's current fundamentals and a bet on its future cash flow or profits. Now, this mechanism isn't that big of a problem in and of itself. Yes, you could get in trouble with the SEC if a token like this behaves too much like a stock, but for the most part, it's not the cause of FTX collapse. Although it is important to understand. Binance, the largest cryptocurrency exchange, also has BNB token, which has very similar functions as FTT token. And so far, it has not collapsed yet. The real reason for FTX collapse began with a trading company called Alameda Research, which is another company co-founded and owned by SBF. It's a quantitative trading firm that does crypto arbitrage, meaning that it makes money by buying cryptocurrencies in one part of the world and selling them in another. Very simple. On November 2nd, CoinDesk published a report that states most of Alameda's $14.6 billion assets are actually made up of FTT tokens. $5.9 billion of its assets were unlocked FTTs and FTT collateral, and with $7.4 billion worth of loans. This had people concerned about Alameda's balance sheet, because 1, it owes a lot of money, and 2, most of its assets were comprised of some very illiquid tokens that were created out of thin air by the same person who founds Alameda, and that just concentrates the risk even more. Not to mention, other cryptocurrencies that they do own are also illiquid and may not be worth as much as they might think. So, there were concerns that the company could not meet its obligations and might need to divest its FTTs, which will push its value down. And it is likely that FTX also had a big chunk of FTT on its balance sheet and therefore could be hurt should a downward spiral happen, which it did. This revelation is enough for CZ, the CEO of Binance, to threaten to sell his FTT token in the open market, causing a panic that causes the price of FTT to fall roughly 90%. This chain of events sparked a run on the exchange, with customers withdrawing roughly $5 billion before FTX paused withdrawals, as they didn't have enough money to cover that amount of withdrawals. This sequence of events all happened in a matter of days, which is incredibly fast even compared to traditional finance. By the way, the event is very similar to Bear Stearns' collapse back in 2008. So, what's next for FTX? There are two paths that FTX could take here. One is to find a company that is willing to take on its liabilities, sort of like what JP Morgan did back in 2008 when it bought Bear at the basement price of $2 per share. In this case, FTX may even have to pay for someone to take its liabilities because the condition is so bad. And it's hard to imagine that anyone wants to own the accounts and liabilities of an exchange like FTX. The second option is to liquidate all of its holdings and file for Chapter 11 bankruptcy, which seems like the route they're taking. In this case, crypto traders who were unable to withdraw funds from FTX will mostly lose their money. Now, let's talk about cryptocurrency and how its future may shape out from now. The first is that the domino effects of FTX collapse has caused a sell-off of Bitcoin and other assets. As institutional investors are losing a ton of money, they might have to liquidate in other places including other crypto investments or even beyond crypto to make up for the difference. This seems to be the case for VCs like Sequoia Capital who have a lot of exposure to FTX. Meanwhile, another side of the story that is important to talk about is influencers. FTX is a massive sponsor on YouTube and most big finance channels used to have an FTX ad segment in the video or an affiliate link in the description. And with this stuff unfolding, we see lots of creators publish a video apologizing to their viewers saying that they were wrong. While I don't fully blame influencers for taking on deals from FTX, any channel that want to feature an ad on their channel must at least do some due diligence about things like consumer protection to prevent their viewers from getting scammed. Even something as simple as checking whether that company is registered with the SEC or not, or if it involves deposits whether it is FDIC insured or not, can go a long way. The extent of this crisis is bigger than any of the crises experienced in the crypto industry before. So hopefully, influencers and viewers alike will have learned their lesson by now, though I highly doubt it. And one word that we're going to see a lot of from the crypto industry going forward is regulation. I think the crypto industry highlights best what a financial system with little to no regulation looks like. A Wild West where scams and unscrupulous behavior are rampant. Let's not forget that before the saga happened, SBF was considered a reputable individual in the crypto space, and his company FTX was one of the most reputable companies involving crypto. Now, the good news for any crypto believers is that you're certainly not alone. In a recent article published by the World Economic Forum, they described that in a survey conducted in the US, about 53% of Americans believe that cryptocurrency is the future of finance. And this transcends political parties as the majority of both Democrats and Republicans agree. And the survey also found that 79% of Americans who believe in crypto want clearer regulation in the space. With the FTX saga happening, this presents an opportunity for policymakers to regulate an industry that most of its believers want to be regulated anyway. For those of you who are skeptical about crypto, this is a time when you can expect that investment into the sector from banks and VCs will drastically slow down, especially since we've seen a boom of institutional exposure in the crypto space for some years. But this looks like a moment where traditional finance might take a step back and reevaluate its exposure, at least for the time being. And that's good. If banks and VCs are more careful in their involvement in crypto, then that is going to make the industry better and more resilient. Or maybe we found that it has no real-world purposes. Now, although the crypto industry has been riddled with crises, so far it has been able to bounce back every single time. Although that's not to say that it will happen again. Nobody knows about the future. This is Doverhill, and see you next time.